Hello group. This chapter is all about adjusting entries, and I want to go through some of the adjusting entries of what you may be seeing for this chapter. The first one that I want to do here is company purchased a one-year insurance policy for $18,000 on October 1st, 2019. So what we would do is we would date this 10/1, and we're going to call this prepaid insurance because we are paying for a one-year insurance policy. We'll debit $18,000 in cash, or sorry, 18,000 as the debit, and then we're going to credit our cash for $18,000. Now, adjusting entries means that we have to do an adjustment at the end of the year for anything that has expired. So I want to prepare the adjusting entry for the amount of insurance that has expired at the end of the year. So for 12/31, I need to record insurance expense. And I need to figure out how much that is. Well, it was $18,000, and if I divide that by 12, so if I do 18,000, I divide that by 12, that equals $1,500 a month. Now, I bought this insurance policy October 1st, so it's all of October, all of November, and all of December. So take that times 3. So the amount of insurance that is expensed out for let's say for 2019 is $4,500, and then I'm going to credit insurance expense by reducing the amount that we owe. Okay, so you'll come across that one. Here's one that you've probably already experienced in Chapter 2, but we're going to continually to do this one. So September supplies account on balance on September 30th is $5,700. The supplies on hand on September 30th are $2,500. So sometime during the period, I had purchased $5,700 worth of supplies. I went into my closet, opened up the door, counted my supplies, and I have $2,500 of supplies left. So what I need to do here is I need to get my balance to the $2,500. So I have actually used up $3,200 worth of supplies, and I will also reduce my supplies account by $3,200. If we took $5,700 minus $3,200, it will show that our balance is $2,500. So watch that because you want to get your supplies down to the $2,500. So we've used $3,200 worth of supplies. Okay, at the end of the year, of the current year, $25,700 of fees have been earned but have not been billed. So the 31st comes along, we look at our accounting records and realize, okay, we need to bill our customers. Well, let's type that right. The $25,700. Because of being accrued accounting, we will recognize those fees earned when they actually happened. Okay, so the next one that I have, cruise company pays weekly salaries of $10,200 on Friday for a 5-day work week ending on that day. If the accounting period ends on a Wednesday, journalize the necessary adjusting entries at the end of the accounting period. Okay, so we'll say that this was 12/31. What we need to account for with salaries expense, the $10,200 for a 5-day work period means that every day of the week we expense out $2,040 in salaries. If it ends on a Wednesday, but I don't pay for Friday, I need to expense out Monday, Tuesdays, and Wednesday salaries because the employees have earned it, is an expense to us. We will do salaries expense and salaries payable for $6,120. I won't go into everything else that we will do for this transaction, but note that then Friday we will reduce that salaries payable account down. But I don't want to get too far in advance, so what we're doing, we'll experience that transaction more. Number 6, the estimated amount of depreciation on equipment for the current year is $7,200. Okay, brand new account that we will be playing with is depreciation expense. Depreciation is when we reduce the value of a piece of equipment, kind of like when you go to the dealership, you buy a car, as soon as it drives off the dealership, its value reduces. So what we need to do for our equipment is we need to reduce its value on a monthly, yearly basis. For this chapter, until we get further in, we will be giving you the account. And then a new account, accumulated depreciation, also for $7,200. Okay. The balance in the unearned fees account before adjustment at the end of the year is $325,000. Journal the adjusting entry required, assuming that the amount of unearned fees at the end of the year is $225,000. Okay, so what we did was unearned fees. Let me just do this. 325,000 minus 225,000. So we will reduce our unearned fees. And now those are fees earned. Now before I close out on this, one thing you want to look at is minus this one at the end of the year. You will always affect an income statement. Remember, income statement, anything that has an expense goes into the income statement. Prepaid insurance, that is an asset, so that's a balance sheet. So we affected an income account and a balance sheet account. When we adjusted our supplies on September 30th, an income account, a balance sheet account. This one, we haven't billed our customers, so we did a balance sheet account and an income. Accounts receivable is an asset. Fees earned is a revenue, and that goes on your income statement. Salaries expense, income. Salaries payable, similar to accounts payable, that is a liability. So we affected an income statement, we affected a balance sheet. Depreciation expense and accumulated depreciation, we affected a income statement, we affected a balance sheet. Now they talk about this in the book, accumulated depreciation. It is a contra asset because assets have a debit balance. Accumulated depreciation has a credit balance because we are reducing the value of an asset, so we have to credit it. We will get more involved in this account as we go through the chapters. Here, the balance, unearned fees, that is a current liability. So that was a balance sheet, and we moved it to, and we close it out into an income statement revenue account. So these are some of the journal entries that you will be experiencing, the adjusting entries that you may be experiencing throughout this chapter. Go through them, review them, practice them, and any questions, please let me know. Thanks.